This chapter explores the variety of financial assets traded on the stock market. Understanding the characteristics, risk-return profiles, and investment benefits of different asset classes can help investors build a diversified portfolio that matches their goals and risk tolerance. (9.1) Overview of financial assets. Financial assets are grouped by characteristics into equities, debt instruments, commodities, funds, and other alternative investments. Each group has a different combination of risk, return potential, and liquidity. (9.1.1) Equities, shares. Equities represent ownership in a company and offer the potential for capital appreciation, as well as dividends. (1) American Depository Receipts, ADRs. Certificates issued by U.S. banks that represent shares of foreign companies. ADRs allow U.S. investors to gain exposure to foreign companies, like Toyota or Nestle, without dealing with foreign exchanges. (2) Global Depository Receipts, GDRs. Similar to ADRs but traded on international markets. Examples include Gazprom and Infosys GDRs listed on the London Stock Exchange. (3) American Depository Shares, ADSs. The underlying shares represented by ADRs. For instance, one Alibaba ADR might represent multiple shares of Alibaba, stock listed on the Hong Kong Exchange. Risks. 1. Volatility. Equities are subject to significant price fluctuations based on company performance and market conditions. (2) Risk of capital loss. Investors may lose their principal if stock prices decline. (3) Currency and political risks. For ADRs/GDRs, foreign investments expose investors to currency fluctuations and political instability in the issuing country. Mitigation strategies. 1. Diversify across different sectors and regions. 2. Use hedging strategies to manage currency risk in foreign investments. 9.1.2 Debt instruments, bonds. Debt instruments represent loans made by investors to issuers, such as governments or corporations in exchange for periodic interest payments. One. Government bonds, issued by national governments. These are considered low-risk investments. Two. Corporate bonds, issued by companies, offering higher returns than government bonds, but with greater risk. Three. Municipal bonds, issued by local governments, often tax-exempt at the federal level. Risks. 1. Interest rate sensitivity. Bond prices fall when interest rates rise. 2. Credit risk. There is a possibility that issuers may default on payments, especially with corporate bonds. Mitigation strategies. 1. Ladder bond investments across different maturities to reduce interest rate risk. 2. Opt for bonds with higher credit ratings or diversify bond holdings. Nine. 1.3 Commodities. Commodities are physical assets such as oil, gold, agricultural products, and metals. 1. Trading methods. Commodities are traded through futures contracts or commodity-linked ETFs, which provide easier access for retail investors. Risks. 1. Volatility. Commodity prices are highly sensitive to global supply, demand dynamics, and geopolitical risks. Mitigation strategies. 1. Use hedging strategies like futures contracts to manage price volatility. 9.1.4 Funds. Funds pool capital from many investors to invest in a diversified portfolio of assets. Mutual funds. Actively managed portfolios designed to meet specific investment goals. Exchange-traded funds, ETFs. Passively managed funds that track indexes or sectors, with lower fees compared to mutual funds. Risks. 1. Management fees. Mutual funds. Actively managed funds often have higher fees that can erode returns over time. 2. Tracking errors, ETFs. ETFs may not perfectly replicate their benchmark index due to liquidity constraints or management inefficiencies. (9.1.5) Real estate investment trusts, REITs. REITs are companies that own or finance income-producing real estate. Key features. 1. REITs typically pay high dividends, providing a steady income stream for investors. Risks. 1. Interest rate sensitivity. REIT prices fluctuate with interest rates, which can affect dividend yields. Two. Property risk. REITs face risks like declining property values or tenant defaults during economic downturns. (9.1.6) Derivatives. Derivatives are financial contracts whose value depends on an underlying asset, such as stocks, bonds, or commodities. Examples include: 1. Options are financial derivatives that give the holder the right, but not the obligation, to buy or sell an underlying asset, such as a stock, bond, or commodity. 2. At a predetermined price, called the strike price, on or before a specific date known as the expiration date. Two. Futures contracts obligate parties to trade an asset at a predetermined price on a future date. Risks. 1. Leverage risk. Derivatives amplify both gains and losses due to leverage. 2. Complexity risk. Derivatives require specialized knowledge and can lead to significant losses if misused. (9.1.7) Cryptocurrency. Cryptocurrency is a digital asset class operating independently of central banks, using cryptography for security. Examples include Bitcoin, BTC, and Ethereum, ETH. Risks. 1. Extreme volatility. Cryptocurrencies experience rapid price fluctuations. 2. Regulatory uncertainty and security risks. Cryptocurrency exchanges are vulnerable to hacking and theft while regulations remain unclear in many jurisdictions. 9.3 Benefits and risks of investing in foreign companies through ADRs. ADRs offer U.S. investors exposure to foreign markets without dealing with foreign exchanges. Benefits: geographical diversification, risks, currency risk. 9.4 Investor profiles and investment strategies. Different investor profiles have varying risk tolerance levels. Conservative investors focus on capital preservation with low-risk assets, like government bonds. Moderate investors balance between growth and capital preservation using a mix of stocks and bonds. Aggressive investors aim for high returns through growth stocks and emerging markets investments. (9.5) Emerging trends in the stock market. The financial landscape is constantly evolving. And while traditional assets like stocks, bonds, and commodities remain essential, new trends are emerging that are reshaping the investment world. Two prominent trends are cryptocurrency and fintech innovations, which offer both opportunities and challenges for investors. (9.5.1) Cryptocurrency. 9.5.1 Cryptocurrency. Cryptocurrency has gained significant attention as a digital asset class. It operates independently of central banks and uses cryptography for security. Cryptocurrencies like Bitcoin, BTC, and Ethereum, ETH, have become popular due to their decentralized nature and potential for high returns. Potential benefits: decentralization. Cryptocurrencies operate on decentralized networks, eliminating the need for intermediaries like banks. Transparency. Transactions are recorded on a public ledger, blockchain, promoting transparency and reducing the risk of fraud. Potential for high returns. Cryptocurrencies have experienced significant price volatility, which can offer high returns for risk Tolerant investors. Potential risks. Volatility. Cryptocurrency prices are highly volatile and subject to rapid fluctuations. For example, Bitcoin's price can swing drastically within short periods. Regulatory uncertainty. The regulatory landscape for cryptocurrencies is still evolving, creating uncertainty for investors. Governments may impose restrictions or regulations that could impact market access or value. Security risks. Cryptocurrency exchanges and wallets can be vulnerable to hacking and theft. Investors must take extra precautions, such as using secure wallets or cold storage solutions. Types of cryptocurrencies. Bitcoin, BTC. The first and most well-known cryptocurrency that uses blockchain technology to record transactions. Ethereum, ETH. A platform that allows developers to build decentralized applications, dApps, using smart contracts. Stablecoins. Cryptocurrencies pegged to stable assets, like the US dollar, to reduce volatility, for example, USDC. Investment strategies. Investors interested in cryptocurrencies should consider starting with a small allocation due to high volatility. Diversification across different types of cryptocurrencies can help reduce risk. Additionally, staying informed about regulatory developments is crucial for managing potential legal risks. (9.5.2) FinTech innovations. 9.5.2 FinTech innovations are disrupting traditional financial services by offering new ways to invest, manage finances, and access capital. These innovations have democratized investing by lowering costs and increasing accessibility. Key fintech innovations impacting the investment landscape. Robo-advisors. Automated platforms that use algorithms to provide personalized portfolio management advice. Typically have lower fees than traditional financial advisors. Suitable for investors with smaller amounts of capital, or those who prefer a hands-off approach. Online brokerage platforms offer direct access to financial markets without the need for traditional brokers. Provide user-friendly interfaces, research tools, and real-time market data. Empower investors to manage their portfolios independently at lower costs. Peer-to-peer lending connects borrowers directly with individual lenders through online platforms. Provides an alternative investment opportunity where investors can earn interest by lending money to borrowers. Offers borrowers potentially lower rates than traditional banks. Impact on the investment landscape. Increased accessibility. Fintech innovations make investing more accessible to a wider range of individuals by lowering barriers such as high fees or minimum investment requirements. Lower fees. Many fintech platforms offer lower fees compared to traditional financial institutions, making them attractive to cost-conscious investors. Enhanced efficiency. Automation in fintech solutions streamlines investment processes, improving efficiency and reducing human error. Innovation. Fintech is driving innovation in financial services by creating new investment opportunities such as fractional shares, algorithmic trading strategies, and decentralized finance, DeFi. Risks associated with fintech. While fintech offers many benefits, there are risks associated with over-reliance on algorithms and technology-driven platforms. For example, 1. Automated systems may not account for unique market conditions or investor-specific needs during volatile periods. 2. Cybersecurity risks are elevated due to the digital nature of these platforms. 9.6 Conclusion. The stock market offers a wide array of financial assets that cater to different investor profiles, from conservative bondholders seeking stability to aggressive traders looking for high returns in emerging markets like cryptocurrency. Understanding the characteristics, risks, and return potential of each asset class is crucial for building a diversified portfolio that aligns with your investment goals. As new trends such as cryptocurrency and fintech continue to reshape the investment landscape, it's important for investors to stay informed about these developments. while carefully managing associated risks. Whether you're a conservative investor focused on capital preservation, or an aggressive investor chasing high growth, there's a place for everyone in today's dynamic financial markets.